Trading is a world that promises freedom, but often delivers tough lessons. We're diving deep into this realm, using Dr. Proceeds, with Alexander Elder's groundbreaking insights from his book, which uniquely connects psychiatric understanding with market realities. The core of our exploration isn't about complex algorithms or secret indicators. Instead, it's about mastering your own mind and understanding the collective psychology of the market crowd. Whether you're just starting out, looking to refine your strategy, or fascinated by the human drama behind trading, this deep dive is for you. Dr. Elder frames trading as the last frontier, a path to genuine independence. Imagine working from a beachside cafe or a quiet mountain retreat, setting your own hours and being your own boss. But this freedom isn't just about location, it's about psychological resilience and disciplined approach. What makes Elder's perspective truly powerful is how he reveals that sustainable trading success is rooted more in self-mastery than in mathematical complexity. He champions an approach that cuts through the frantic chase for quick profits, focusing instead on foundational truths often overlooked by traders. Our mission is to extract the most vital wisdom from his work. We'll help you navigate dynamic markets with greater awareness, control, and serenity. The goal isn't just to understand trading techniques, but to develop an unwavering mental discipline that transforms how you engage with financial markets. Ultimately, trading is less about numbers and more about understanding human psychology, both your own and the market's collective mindset. By embracing this perspective, you can move beyond traditional trading constraints and create a more meaningful, controlled approach to financial speculation. Trading isn't just about numbers or technical skills. Dr. Technical Skills, Alexander Elder's journey reveals something far deeper. When he first arrived in New York in 1974, with just $25, he knew nothing about stocks. A simple paperback book sparked his initial interest, and his first trades actually made money, which unfortunately created a dangerous illusion that making money would be easy. The real breakthrough came from understanding something profound. Success is fundamentally about psychology. His background in psychiatry gave him unique insights into trading dynamics. While completing his psychiatric residency and exploring psychoanalysis, he was simultaneously learning market complexities. His crucial realization was that winning starts inside your mind, not through complicated computer algorithms. Most people fail not because they lack intelligence, but because they don't truly understand the market's nature. Elder emphasizes that success requires rigorous self-control and a deep comprehension of unpredictable market currents. Many aspire to trading freedom, but few actually succeed. It takes more than technical knowledge, it demands disciplined mental awareness. His work, Trading for a Living, powerfully demonstrates this principle. Even after 2 decades, the psychological components remain remarkably consistent. While market tools and dynamics continuously evolve, human behavior's fundamental patterns stay unchanged. Elder's approach proves that understanding yourself is the most critical trading skill. This isn't just about making money. It's about mastering your internal landscape, recognizing your own psychological patterns, and developing the mental discipline required to navigate complex, shifting environments. Trading becomes a profound journey of self-discovery and personal growth. Psychology means understanding your own mind, emotions, biases, and impulses. It's not just a useful skill, it's foundational. Dr. Elder cuts right to the heart of success with a powerful question and a revealing story about weight loss. His friend's wife claimed she wanted to lose weight. She'd publicly avoid cake but secretly indulge in the kitchen. She chose immediate pleasure over her long-term goal. This behavior mirrors traders who talk about consistent success and discipline, but repeatedly make impulsive trades. Unconsciously, these traders prioritize short-term thrills, the emotional rush of a risky bet over meticulous planning and patient execution. Dr. Elder believes genuine success requires treating trading as a serious intellectual pursuit. This means protecting capital as carefully as a professional scuba diver monitors air supply in an unpredictable ocean. We all enter the market carrying unique mental baggage, preconceived ideas and deep-seated beliefs operating just beneath the surface. Dr. Elder identifies widespread fantasies traders cling to, comparing them to children afraid of cemeteries or monsters under the bed. These fantasies offer temporary comfort, but critically prevent traders from facing reality. They subtly yet profoundly influence behavior, often leading down the wrong path. Like a child imagining being adopted to explain an unfriendly world, traders create stories that feel safe but ultimately sabotage success. Dr. Elder aims to expose these fantasies, highlighting how they consistently trip up aspiring traders. The first major fantasy he identifies reveals how deeply psychological patterns can derail financial goals. The path to trading success isn't about having a massive account. Many traders fall into this trap after losing money, believing they would have profited if they just had more capital. Doctor just had more capital. Elder highlights a brutal truth. The problem isn't financial, it's psychological. He tells a shocking story of an acquaintance who lost $200 million in a single day. Even after such devastating loss, this person still blamed external factors, repeating, "If only I had a bigger account." This demonstrates that the real issue lies within the trader's mindset, not their bank balance. Trading success isn't about money volume, it's about mental development. Traders often get wiped out and then watch the market move exactly as they predicted, which only intensifies their frustration. They sit fuming, convinced they would have made a fortune with just a bit more staying power. Another dangerous myth is the idea of automated trading. Many intelligent professionals spend thousands on systems promising effortless profits. Dr. Elder compares this to medieval knights seeking alchemists who claimed they could turn base metals into gold. Markets are living, breathing entities that constantly evolve. What works brilliantly today might fail tomorrow. Automatic systems can't adapt, but skilled human traders can. He illustrates this with an airline pilot analogy. Companies pay pilots large salaries because humans can handle unexpected situations like engine failures or structural damage. The pursuit of wealth cannot be automated. These trading systems are often driven by a combination of greed, laziness, and a fundamental misunderstanding of market probabilities. Successful trading requires human judgment, flexibility, and psychological resilience. Any unexpected market event could cause your account to crash completely. This stark reality leads him to explore the deeply rooted myth of guru worship in financial circles. He breaks down gurus into 3 distinct categories: market cycle gurus, magic method gurus, and dead gurus. Market cycle gurus operate like trend-following fashion models, gaining popularity when their predictions coincidentally align with market conditions. Their fame is entirely timing-based. Magic method gurus typically inhabit the derivatives world, selling supposed secret keys to market profits. Traders desperate for an effortless path to wealth eagerly purchase these methods, much like medieval knights seeking the perfect sword. However, Dr. Elder reveals a crucial insight. These methods inevitably lose effectiveness as more people adopt them. Markets continuously erode each method's competitive edge. Interestingly, gurus tend to emerge from market fringes, but their downfall is predictable. Once mainstream media like Forbes or Businessweek features them, it signals their peak effectiveness has passed. The guru's mystique disintegrates under widespread exposure. Dr. Widespread exposure. Elder himself rejects the guru label. He emphasizes personal responsibility, repeatedly stating that no external expert can make you rich. Success requires your own dedicated work. Beyond financial strategies, Elder delves into a deeper psychological terrain. He identifies self-destructiveness as the fundamental cause of most failures, not just in trading, but across life's entire landscape. This unconscious desire to fail manifests through subtle self-sabotage, undermining work, relationships, and financial potential. The core message remains consistent. True success demands personal accountability, continuous learning, and confronting internal psychological barriers. 9. A successful pharmacist's life story reveals a recurring pattern of systematically undermining his own achievements. His career trajectory is marked by dramatic rises and falls. Establishing a pharmacy, transitioning to brokerage, reaching the top, facing lawsuits, and repeatedly failing as a trader. Throughout these experiences, he consistently attributed his failures to external factors, blaming envious bosses, incompetent regulators, and an unsupportive spouse. Trading stands unique among professions, offering unprecedented opportunities for self-destruction. Unlike other careers with built-in safety nets like supervisors or supportive colleagues, trading operates in a silent, unforgiving environment. The market simply absorbs your losses without guidance or intervention. Breaking this cycle of self-sabotage demands profound self-awareness and total personal accountability. Critically, maintaining a trading diary becomes essential. Traders must become their own honest observers, meticulously tracking repetitive patterns of success and failure. Dr. Degas appears of definitive patterns of success and failure. Elder draws a fascinating parallel between trading strategies and Alcoholics Anonymous principles. While seemingly counterintuitive, he argues that AA's core concepts can effectively help traders combat self-destructive tendencies. The first fundamental AA step, admitting powerlessness over alcohol, directly translates to traders acknowledging their inability to control market movements. He even proposes a Losers Anonymous concept, believing that confronting self-destructive behaviors head-on requires harsh, direct terminality. As an illustrative example, he recounts a successful religious woman trader who swiftly cuts losses, motivated by her commitment to responsible financial stewardship. The analogy is compelling. In a race between a sober individual and someone intoxicated, who would you bet on? Similarly, recognizing and addressing one's destructive trading behaviors is crucial for long-term success. Some thinking generates serenity, allowing traders to focus solely on the best and safest trades without the tension and impulsive actions that typically derail emotional traders. This calm mindset creates fertile ground for rational decisions. A key concept introduced is the businessman's risk rule. This will account equity for any single trade. With a $30,000 account, you can only risk $600 per trade. Traders must treat this rule like a recovering alcoholic avoids bars as an inviolable life-saving principle for long-term survival. Record-keeping is crucial in this approach. Good businessmen maintain comprehensive documentation. Every trade detail matters: date, price, slippage, commissions, stops, entry and exit reasons, profit goals, and maximum paper profit or loss. These records become a brutally honest personal teacher. The strategy suggests traders adopt a mindset similar to recovering alcoholics. They should constantly remind themselves to stay humble and disciplined, focused on avoiding losses. This isn't about self-criticism, but maintaining relentless focus on sound decision-making. Zooming out from individual psychology reveals a broader market perspective. Markets aren't just collections of individual decisions, they're complex crowd behaviors. Each price, tick, represents a momentary agreement between a buyer and seller, reflecting a fluid consensus of value. Elder emphasizes that market prices aren't absolute truths, but dynamic expressions of collective emotion. Crowds behave remarkably similarly across different cultures and continents, driven by universal human tendencies of fear and collective sentiment. This insight provides a deeper understanding of market dynamics beyond individual trading strategies. There's a deep, almost primitive urge to join crowds and mimic others. It's a powerful impulse that can dramatically affect trading decisions. Smart traders understand this tendency but don't let it control them. Historical examples vividly illustrate how collective behavior can lead to financial disaster. Charles Mackay's work from 1841 explored these patterns, documenting events like the tulip mania in Holland and the South Seas bubble in England. French philosopher Gustave Le Bol's research in 1897 further examined crowd psychology. Mark Douglas captured this phenomenon perfectly, noting that in markets, there's no inherent structure beyond what we create in our minds. People naturally seek leadership during uncertainty, which can trigger impulsive and irrational actions. A scientist who might be entirely rational in a laboratory can suddenly make reckless trades when caught up in market hysteria. The core lesson is both simple and profound. Crowds can cloud judgment, men go mad collectively, and return to reason slowly, one by one. Traders, who truly understand this, can actually profit by recognizing and intelligently exploiting these predictable patterns of group behavior. Dr. Elder emphasizes that while you don't need to run with the crowd, you absolutely shouldn't run against it. The independent trader respects crowd strength without being controlled by it. This approach allows for strategic navigation of market dynamics, turning collective behavior from a potential pitfall into a potential opportunity. The enduring wisdom across centuries remains consistent. Understanding human psychology is just as crucial in trading as understanding financial metrics. Recognizing these deep-seated behavioral patterns can be the difference between success and failure in any market. Not trading system relies on rational, pre-planned decisions made before emotions take over. Doctor traveling decisions made before emotions take over. Doctor traveling decisions, Elder explores this concept by examining group dynamics and information flow in markets. Not all trading groups are inherently bad. Using James Surowiecki's work on crowd wisdom, he distinguishes between typical groups prone to emotional contagion and smart groups. In smart groups, members make independent decisions without influencing each other, allowing diverse expertise to emerge without the emotional waves that often disrupt market behavior. Insider trading reveals fascinating market dynamics. Legal insider trading occurs when corporate executives or large stockholders consistently buy and sell in coordinated patterns, often signaling significant upcoming events. These collective actions can be a powerful indicator for observant traders. While high-profile illegal insider trading cases get prosecuted, extensive networks remain largely undetected. Elder uses a colorful analogy of golfing buddies exchanging tips at a country club to illustrate how difficult these networks are to police. Interestingly, insider trading is actually legal in futures markets. Some firms have sophisticated intelligence networks that provide critical advantages. One example involves an oil firm executive learning about a North Sea fire before public news broke, enabling him to purchase futures minutes before prices surged. Individual traders face significant challenges. Trading floors with real-time information sources give institutional players clear advantages. The Squawk Box, for instance, provides instant updates that home traders simply cannot access. Understanding these limitations becomes crucial for developing realistic trading strategies. The core lesson remains consistent. Successful trading requires independent decision-making, disciplined systems, and a clear-eyed view of market information dynamics. Not trading well is about being patient, not trading often. Elder emphasizes that overtrading squanders potential advantages. Instead of chasing every market signal, traders should focus on careful, measured decisions. Market psychology plays a critical role in successful trading. The contrary opinion theory reveals fascinating insights. When financial journalists and newsletter writers become overwhelmingly bullish or bearish, it often signals a prime opportunity to trade against the crowd. These market commentators tend to miss turning points, creating openings for smart contrarian investors. Multiple tools help track market sentiment. The commitments of futures traders Coty, reports provide deep insights by breaking down positions held by different market participants. Hedgers, typically considered the smart money, use futures to manage business risks. Small traders, in contrast, are often overly optimistic and frequently find themselves on the wrong side of major market shifts. By comparing current positions to historical norms, traders can gain valuable market direction insights. Sophisticated investors watch for subtle signals, like when smart money quietly builds or reduces positions. Risk management is the absolute cornerstone of trading success. Dr. Elder is unequivocal about this point. Survival in trading isn't just about making winning trades. It's about protecting yourself from potential losses. Many traders stumble by failing to manage their risk effectively, often freezing or stubbornly holding losing positions, driven by emotional desperation. The key is understanding market psychology, tracking sentiment indicators, and maintaining disciplined risk management. Successful trading requires patience, strategic thinking, and the ability to move against the crowd when necessary. Market trading can easily turn into a devastating downward spiral that crushes financial hopes. Traders often fall into a trap where they desperately wait for losses to miraculously turn around, which typically leads to catastrophic account destruction. What's worse, markets seem to have a cruel tendency to reverse direction precisely when frustrated traders finally surrender and exit their positions. Dr. Elder offers a critical framework to combat this self-destructive cycle. The iron triangle of risk control. This approach requires defining 3 essential elements for every trade: entry point, target, and stop. Placing a trade without clearly establishing these 3 numbers is nothing more than gambling. 2 powerful safety nets help implement this systematic approach. The first is the 2% rule, which strictly limits losses on any single trade to no more than 2% of total account equity. Consider a $50,000 trillion rating account. The maximum risk on any trade would be $1,000. This rule not only protects against devastating losses, but also helps determine position size. Here's how the position sizing works. If your stop placement means risking $1.50 per share, you divide your maximum dollar risk, $1,000, by the risk per share, $1.50, resulting in approximately 666 shares. This method becomes especially crucial in futures trading, where leverage can be extremely dangerous. Futures trading illustrates this risk perfectly. Imagine controlling $100,000 worth of crude oil futures with just $5,000 in your account, a 20-to-1 leverage. A tiny 1% market move against you could wipe out 20% of your capital, while a 5% move could potentially devastate your entire investment. You must absolutely know your precise entry point, expected profit target, and maximum loss point before committing a single dollar. These rules act like safety nets, protecting you from both sudden catastrophic losses and the slow, insidious bleeding caused by multiple small losses. Not margin trading can quickly wipe out your entire initial investment if you're not careful. Small price changes can devastate your equity in an instant. The 6% rule serves as a critical safety net. It limits your total monthly losses to no more than 6% of your starting account equity. This approach prevents gradual financial erosion through a series of seemingly minor losses that could collectively strip your account bare. Before entering any new trade, you must carefully calculate the cumulative risk. This means adding up all losses from the month plus potential risks on current open trades. If this total reaches 6% of your starting monthly equity, you're prohibited from opening new trades until the month ends or existing trades move favorably. Dr. Time points. Elder shares a compelling example about a trader who struggled for 13 consecutive days. The trader was advised to dramatically reduce his share size from 500 to just 100 and increase it only after 2 consecutive profitable weeks. Initially resistant, he eventually started generating consistent, though small, profits. This story highlights how psychological wins and steady small gains are crucial for rebuilding confidence and enabling financial recovery. Many successful institutional traders rely on trading managers who strictly enforce risk limits. When these traders work independently, they often struggle without external discipline. The key takeaway is the importance of having a robust system. Trading systems are developed during calm, rational moments and serve as an anchor during market turbulence. They provide a structured approach to managing risk and maintaining emotional control. Ultimately, these rules aren't just about protection, they're about creating a sustainable, disciplined trading strategy that can weather market volatility. Elder explores two distinct system types in trading: mechanical and discretionary. Mechanical systems operate on strict, predefined rules with zero flexibility. While this approach can reduce decision-making stress, it carries a critical weakness. Markets aren't static machines but dynamic environments, constantly evolving. Human judgment becomes essential because markets are living, breathing ecosystems of continuously adapting participants. Discretionary systems offer greater adaptability, remaining responsive to subtle market shifts and emerging opportunities. His recommended strategy is a balanced hybrid approach. By using mechanical rules as an initial filtering mechanism, traders can eliminate potentially problematic trades while maintaining the flexibility to respond to unique market conditions. This method preserves rational boundaries while allowing strategic responsiveness. Testing these systems requires careful, thoughtful evaluation. Thoughtful evaluation. Dr. Stiges, Elder strongly warns against relying solely on backtesting software, which provides impressive printouts but fails to simulate the emotional complexity of real trading. Software cannot replicate the psychological challenges of consecutive losses or unexpected market gaps. Instead, he advocates for manual, one bar at a time testing. Though slow and time-consuming, this method most authentically models genuine decision-making. Traders meticulously move through historical data, making explicit trading decisions and recording outcomes. This process builds critical decision-making muscles and provides a more genuine market experience. Paper trading serves a deeper purpose beyond profit simulation. It tests a trader's discipline and system consistency, like practicing sailing on a calm pond before navigating stormy seas. It confirms a trader's ability to maintain composure under pressure. Once a system is thoroughly tested and discipline confirmed, discipline confirmed, Elder recommends gradually introducing small real money trades. One positions require gradual size increases only after consistent positive results emerge. This approach builds both confidence and capital methodically, step by step. Technical analysis has undergone a massive transformation, as Dr. Elder vividly illustrates through his personal journey. He remembers his first Apple IIe computer, with just 2 floppy drives, each holding a mere 300 KB disk. At the time, even purchasing a 5 MB hard drive seemed extravagant, something no one could possibly need. The computer revolution fundamentally changed. Market analysis. Computers liberated traders from tedious chart updates, giving them more time to think and analyze. These tools offer immense analytical power at minimal cost. Yet, Dr. Elder notes a significant trade-off. We've lost the intimate physical connection to price movements that manual charting provided. Computerized technical analysis brings greater objectivity. Indicators are now clearly rising or falling, eliminating subjective guesswork. Dr. Elder distinguishes between different analytical approaches: toolboxes, black boxes, and gray boxes. Toolboxes like stockcharts.com provide flexible electronic tools for processing market data. They empower traders to build custom analytical frameworks. Black boxes, conversely, are presented as magical solutions that tell you what and when to trade without explaining why. Despite impressive performance claims, Dr. Elder warns these ultimately fail because markets constantly evolve. His conclusion is unequivocal. The only way to profit from a black box is by selling one. Complex human activities like trading cannot be fully automated or reduced to a simple button. Gray boxes offer a nuanced middle ground, providing some transparency about their underlying mechanisms. Nor trading principles allow for more flexible parameters. Breaking away from completely opaque black boxes. The real power in trading stems from understanding your tools and building personal conviction, not from blindly following some magical strategy. A black box makes you dependent, while a toolbox transforms you into a master craftsman. This distinction matters deeply. With market data swirling everywhere, how can we actually make sense of it all? It's like deciphering a complex language filled with subtle nuances and hidden messages. Breaking down fundamental components becomes crucial. Bar charts and Japanese candlesticks are essential visual tools. They reveal the open, high, low, and close prices for a specific period, along with trading volume. Candlestick charts communicate market dynamics through color and shape. White or green bodies indicate the closing price was higher than the opening price, bulls winning that round. Black or red bodies signal the opposite, bears emerging victorious. The wicks or shadows, extending above and below each body, illustrate the extreme price points reached, showcasing the full battle between market participants. Bar height provides additional insight. Average bars represent calm market conditions, while tall, stretched bars signal intense conflict and high participation. These volatile bars might offer profit opportunities for existing positions, but entering new trades during such periods is risky, comparable to jumping onto a moving train. Support and resistance levels further explain market psychology. Dr. Elder describes them as a floor and ceiling with prices caught between. These aren't random chart lines, but reflections of collective trader emotions. Traders holding losing positions seek to break even when the market offers a chance. Those who missed earlier opportunities wait for a similar price point, creating psychological barriers that solidify these trading zones. Critically, these levels are most effectively drawn across congestion areas where significant trading occurred, rather than simply connecting absolute price extremes, not trending strongly up or down. Elder points out that trading ranges dominate market behavior, with strong trends being less frequent. This understanding demands different tactical approaches. In trading ranges, you'll want tighter stops and aim to buy near support and sell near resistance. By contrast, strong trends allow wider stops that give the trend room to breathe. The key is recognizing which market state you're operating within. Professionals approach breakouts differently from amateurs, where novices eagerly chase support or resistance breaches. Experienced traders often fade these moves. Knowing many breakouts ultimately fail, this strategy requires significant nerve. Trading's core challenge involves confronting uncertainty. Old charts might look clear in hindsight, but future market movements remain fluid. Professionals prioritize getting out of losing trades quickly rather than stubbornly defending their initial analysis. Ego is expensive in trading. Dr. Elder warns against seeking a single magical indicator. Markets are too complex for such simplistic solutions. Instead, he recommends using a small number of indicators from different groups, remembering that most derive from 5 core data points: open, high, low, close, and volume. Exponential moving averages, EMAs, become particularly useful for identifying trends and potential reversals. Unlike simple moving averages, EMAs weight recent price action more heavily, reflecting the latest crowd sentiment. Dr. Elder suggests pairing EMAs like a 26-day and 13-day EMA to capture market dynamics more effectively. The critical lesson is adaptability. Understanding market psychology means recognizing when to hold, when to exit, and how to interpret price movements without becoming emotionally attached to a particular view. Moving averages play a crucial role in identifying value zones, where buying and selling opportunities emerge. Traders like Dr. Jen Elder use these tools to spot potential market movements. The MACD indicator, developed by Gerald Apple, uses 3 exponential moving averages to measure market momentum. Its real power lies in detecting divergences, subtle shifts in market psychology. A bullish divergence occurs when prices hit a new low, but the MACD histogram shows a shallower low, suggesting bear power is weakening. Dr. Elder points to the 2007 to 2009 DJIA weekly chart as a prime example of this signal. Conversely, a bearish divergence happens when prices reach a new high, but the MACD histogram creates a lower peak, indicating bulls are losing strength. Crucially, for a true divergence, the MACD histogram must cross and recross its zero line between peaks or troughs, confirming momentum shifts. Another powerful tool is the directional system, ADVAX, which identifies trend direction and strength. The ADX line measures the spread between positive and negative directional lines. A rising ADX suggests a strengthening trend, while a low ADX followed by a significant rally signals the potential start of a new, powerful market movement. The Force Index offers a brilliant method of combining price and volume data. A short-term 2-day exponential moving average can pinpoint critical pullbacks during established trends, providing optimal entry points. For instance, traders might examine an Adobe daily chart to identify strategic trading opportunities within a weekly trend. These technical analysis tools help traders understand market dynamics, revealing hidden opportunities within price movements and volume patterns. By carefully interpreting these indicators, traders can make more informed decisions about market entry and exit points. Trading volume and open interest reveal crucial insights into market psychology. Falling volume often indicates that fewer participants are panicking, suggesting a potential trend reversal. Volume spikes are more likely to signal a downtrend reversal, which tends to be fear-driven, intense, and short, compared to uptrends that are typically greed-driven, slower, and steadier. The Force Index offers valuable trading signals across different time frames. A 2-day Force Index dropping below zero can highlight excellent buying opportunities during short-term daily pullbacks. A longer-term 13-day EMA helps confirm major trends and signal potential reversals through divergences. Open interest, specific to futures and options, reflects the conflict between bulls and bears. Rising open interest during a price decline often suggests bearish conditions, indicating active bottom picking that might get squeezed if prices continue falling. Similarly, falling open interest during a rally can also signal bearishness, potentially meaning existing long positions are taking profits while short positions are covering. Dr. Cochise are covering. Dr. Cochise, Elder's triple-screen trading system, provides a structured approach to navigating these complex market movements. A key observation is that time frames generally relate to each other by a factor of 5. For instance, a 10-minute chart roughly corresponds to an hourly chart, and a daily chart relates to a weekly chart. The system emphasizes starting with a longer time frame to establish a strategic view before switching to shorter time frames for tactical timing. This approach prevents shorter-term market noise from overshadowing the dominant longer-term market direction. The first screen focuses on identifying the overall weekly trend using trend-following indicators like the MACD histogram slope. Elder's trading approach revolves around a multi-screen strategy that carefully controls trade selection and risk. The first screen determines overall market direction by identifying weekly trends. Traders look only for buys during uptrends, shorts during downtrends, or simply stand aside when direction is unclear. A visual impulse system helps enforce this discipline, coding chart bars in green for bullish, red for bearish, or blue for neutral, based on specific technical indicators. The system provides clear rules. For example, never buying on a red bearish impulse bar. Screen 2 dives deeper by focusing on market wave dynamics within an intermediate time frame, typically daily charts. Oscillators like the 2-day force index, stochastic, or RSI help pinpoint optimal entry points. In an uptrend, traders seek strategic dips, such as when the 2-day force index drops below zero, rather than chasing higher prices. Though not explicitly outlined, a third screen often involves an even shorter time frame or specific chart pattern for precise entry triggers. Swing traders might pair weekly and daily charts, while day traders could use 25-minute and 5-minute charts. The strategy's core principle is selecting an intermediate chart and pairing it with a longer-term chart, roughly 5 times its duration. Profit targets derive from the longer-term chart, like key weekly resistance levels. However, protective stops get placed on the intermediate time frame for tighter risk management. This approach balances ambitious market goals with careful capital protection. By strategically aligning tactical exits with broader market trends, traders create a robust framework encompassing psychological discipline, risk control, and analytical tools. And Forex trading requires a nuanced perspective, especially through Dr. Elder's cautionary lens. He has strong opinions on various investment instruments. Stocks represent ownership certificates in a business, while fundamental values and company health drive long-term prices. The short-term market is a different beast entirely. John Maynard Keynes captured this brilliantly, noting that in the long run, we're all dead. Short-term pricing is driven by human psychology, those primal forces of greed and fear that can push markets in profoundly irrational directions. Warren Buffett's Mr. Market analogy perfectly illustrates this dynamic. Imagine a manic, depressive fellow constantly offering to buy or sell shares. Most times, you should ignore him because his mood swings are unreliable. But when he's deeply depressed and offers shares at rock-bottom prices, that's your buying opportunity. Conversely, when he's wildly manic and quotes an absurd price, it's time to sell. The real challenge, Dr. Sell. The real challenge, Dr. Sell, Elder emphasizes, is avoiding infection by Mr. Market's emotional roller coaster. For practical trading, he strongly advises against spreading yourself too thin. Instead of tracking thousands of instruments, focus intensely on a select few stocks. He personally maintains a broad universe of around 200 stocks, meticulously narrowing down to just a handful for active trading. Quality trumps quantity. ETFs present another interesting case. They promise easy diversification. But Dr. Termus case, Elder warns of hidden complexities. He distinguishes between two ETF markets: the primary market of authorized participants trading at wholesale prices, and the secondary market where private traders operate, essentially always sitting in the back of the bus. Administrative expenses and poor tracking can result in significant haircuts. A Morgan Stanley study revealed ETFs missed their stated targets by an average of 1.25% in 2009, a seemingly small number that substantially impacts returns. Dr. Elder provides stark examples, like a friend who lost $1 million on a volatility ETF that steadily declined 90%, and highlights how many commodity and country ETFs track their underlying assets poorly. Elder addresses bluntly. He points out that an option buyer has just a 1 in 3 chance of winning, while option writers have 2/3 odds in their versal favor. Professional traders often exploit this by selling calls or puts that typically expire worthless, pocketing the initial premium. Time decay works in the seller's favor. Traders can leverage this by writing naked calls or puts far out of the money, expecting them to expire without value. While this strategy sounds incredibly risky, it can offer better risk-reward potential if managed with extreme discipline. However, a critical warning exists. Naked writing involves selling options without owning the underlying stock, which means potential losses could be theoretically unlimited if the market moves against you. For put buying, Dr. moves against you, Elder suggests it only makes sense in rare high-conviction situations where you're seeking an exceptional gain from a major market reversal. In these cases, he recommends purchasing very cheap, far out-of-the-money puts. It's essentially like buying a lottery ticket. You accept the high probability of losing the entire premium for a small chance of an exponential win. Contracts for difference, CFDs, represent another complex trading instrument. These are essentially bets on the future value of a currency, index, or stock, closely resembling spread betting. Notably, the SEC has banned CFDs in the United States. Dr. Elder draws a parallel to how the FDA protected people by preventing harmful drugs like thalidomide from entering the market. Regulators worldwide view CFDs critically. Australia's ASIC, for example, considers them riskier than gambling on horses or in casinos. They've observed that CFDs are aggressively marketed to inexperienced traders, emphasizing potential gains while downplaying significant risks. Futures contracts offer a different perspective, with a definite size and fixed settlement date that provides traders a unique reality check. Unlike stock trading, where most participants simply buy, futures trading involves more nuanced strategies and considerations. In the world of futures trading, playing both long and short positions is crucial. However, the failure rate is shocking. 9 out of 10 newcomers typically bust out within their first few months. This high failure rate stems from poor risk management skills and the allure of paper-thin margins. Leverage is the real danger. Small margins, often just 3 to 5%, can enable an account of $40,000 trillion so control merchandise worth $1 million. Dr. So is $1 million in pattern. Elder warns that such power is deadly for amateurs lacking iron discipline. He recommends futures trading only for serious traders with excellent money management skills. The advice is straightforward. Start in markets where you have fundamental knowledge. A cattle rancher trading cattle futures, or beginning in affordable, liquid markets like corn, sugar, or copper makes sense. Then there's Forex, a decentralized market ripe with potential pitfalls. Forex brokers often operate like predatory bucket shops, actively wanting clients to lose. They employ numerous fraudulent tactics, manipulating bid spreads, tweaking buy and sell prices to guarantee their profit, and charging arbitrary settlement fees on non-existent positions. But the most terrifying aspect is the leverage. Leverage offers of 100, 1, or even 400, 1 are common. Such extreme ratios mean the slightest price movement can instantly wipe out an entire account. Dr. Elder shares a cautionary tale about a multimillionaire stock trader who tested brokers by placing unusual orders late at night. Out of many houses tested, only 2 didn't manipulate the trades, revealing the widespread fraud in this largely unregulated space. The message is clear. In Forex, buyer beware. Understanding these risks and developing robust risk management skills can mean the difference between success and total financial destruction. Record keeping stands as the foundation of effective trading, according to Dr. Elder. Memory serves as the cornerstone of civilized life, and without accurate, detailed records, hard-won lessons vanish, and costly mistakes repeat endlessly. The value of maintaining these records is immense. They transform a trader into a self-teacher, systematically learning from successes and failures. Most critically, good record-keeping fights against random reinforcement, those occasional lucky wins that happen for the wrong reasons. Such accidental victories can subtly undermine discipline and encourage inconsistent trading. Dr. Case, Elder's daily homework routine offers a comprehensive approach to market preparation. Before markets open, he establishes a consistent pattern that ensures a calm, analytical mindset. His method involves a complex spreadsheet, version 3.7, when he wrote his book, which tracks global market factors in extraordinary detail. His meticulous review includes checking overseas markets like Australia, China, Germany's DAX, and the UK's FTSE. He monitors the economic calendar, key currencies, commodities like oil and gold, bonds, and even the Baltic Dry Index, which he considers a sensitive global economic indicator. Market breadth indicators form another crucial part of his routine. He examines the new high, new low index, the percentage of stocks above their 50-day moving average, and the force index. These are color-coded green, red, or blue to quickly visualize market impulses. Each day concludes with a critical self-assessment. He tests market expectations by coloring a box green or red based on market performance and conducts a psychological readiness check. This involves reviewing yesterday's trading, planning completeness, and overall mood. A low score on certain questions serves as a warning not to trade. This approach powerfully demonstrates how personal well-being directly impacts trading performance. Trading effectively is impossible when one is not physically or mentally prepared. Not the measure of trading requires a strategic approach, especially when emotions can cloud judgment. At the core of successful trading is a robust planning methodology that helps maintain objectivity and discipline. The trade plan and trade after system serve as critical tools in this process, developed with inspiration from Dr. Virginia Avgar's newborn scoring system and Nobel Prize winner Daniel Kahneman's thinking frameworks. This approach provides traders with an objective method to evaluate potential trades. The trade pair operates on a simple scoring mechanism, using 0, 1, or 2 points across key categories. These categories include weekly income status, daily impulse, market divergence, support and resistance levels, and crucially, the reward to risk. By implementing this system, traders can quickly filter and identify the most promising trade opportunities. Strict decision rules are paramount. Only trade ideas scoring 7 or higher, with no individual category scoring 0, should be pursued. This ensures traders are selecting only the highest quality, most promising setups. Beyond the initial trade plan, maintaining a comprehensive trade journal is essential. Successful traders consistently document not just trade results, but also conduct rigorous post-trade analysis. The recommendation is to revisit each trade 2 months after exit, creating follow-up charts that provide a clearer, less emotionally charged perspective. Tracking equity curves across different markets, strategies, and exit tactics offers invaluable insights. Visualizing the impact of emotional decisions, particularly exits marked by inability to tolerate discomfort, can be a powerful deterrent against undisciplined trading behavior. Methodical approach transforms trading from an impulsive activity to a calculated strategic endeavor. Frazio is far more than just becoming a skilled trader overnight. It's a continuous, lifelong journey of self-improvement that demands dedication and constant learning. Dr. Elder highlights this through different perspectives on mastery. He references the famous 10,000 hours rule typically associated with elite athletes and musicians. For a full-time trader, reaching true expertise could take 5 to 10 years. Yet he also acknowledges Josh Kaufman's work, suggesting basic competence can be achieved more quickly through focused, deliberate effort. What truly resonates is Dr. Trial's cast, Elder's powerful stance that learning never truly stops. His memorable quote, "Reserving the right to be smarter tomorrow than today," encapsulates the essence of trading as an ongoing process of adaptation and humility. This deep exploration reveals trading as more than just numbers on a screen. It's a profound study of human behavior, both individual and collective. Understanding crowd dynamics and maintaining personal discipline are critical. Success hinges on being the rational actor amidst market chaos, someone who can stick to their carefully crafted plan, especially when conditions get challenging. The journey involves developing an internal manager who can navigate the market's complex emotional landscape. This disciplined self becomes the key differentiator between sustained success and repeating costly mistakes. Mark Douglas suggests The market offers complete creative freedom without external restrictions. In this context, trading becomes less about financial transactions and more about personal growth, self-understanding, and continuous evolution. Out here among the volatile charts and flashing numbers, something deeper emerges. It's about commitment, a profound dedication to self-mastery that goes beyond mere surface observations. Your journey isn't just about tracking data or watching markets move. It's fundamentally rooted in unwavering integrity and consistently disciplined decision-making. At its core, this path demands more than technical skills. It requires an inner strength, a resolute approach that transforms raw information into meaningful action. Every choice becomes a reflection of your core principles, every decision a testament to your personal standards. The real work happens not in the numbers, but in the character you build. Discipline isn't just a strategy, it's a way of living, a deliberate choice to stay true to your highest standards, even when external pressures push against you. This commitment shapes not just your professional outcomes, but your entire approach to challenges and opportunities. I apologize, but the text you provided seems to be incomplete or cut off. Could you please provide the full original text that you would like me to rewrite